Hey patrons, how's it going? Today is March 6th, 2022. And so obviously today we're going to be going over our weekly tip for the week. And we're going to talk about debt income ratio first in the first part. And we're going to go more into depth about it. As a reminder, we sent out an alert earlier today. We've talked about debt income ratio before. This was back in 2020, but I feel like we didn't do it enough due diligence or justice because it is for as important as it is as a ratio, very subtle, but very important. I feel like we need to do better due diligence talking about that. And so we're going to go over scenarios and walk through scenarios today. And in addition to that, we're going to talk about specifically tying into debt to income ratio. We'll talk about when you're reporting your income for tax purposes, Schedule C, Schedule E, whatever. Why it's important to be careful with your tax write-offs and the smart and effective way to do it, especially as you think long-term about scaling your portfolio. All right. So that said, we're gonna go dive deep into it. So first things first. So we're gonna go just as a refresher, just to remind people, debt income ratio is basically looking at the total debt, right? So specifically, again, in this weekly tip, we're gonna focus on front end debt income ratio, and front end focuses on just expenses or debt related to the house. So in front end debt income ratio, we're looking at the total debt related to housing expenses divided by your total gross monthly income. So this is your total monthly debt or your monthly expenses or monthly housing expenses total divided by your total gross monthly income. I don't know why that was so difficult to say, but okay. So in this case, so we're going to keep it very simple, this scenario. So we have Devin. Devin is probably like your fresh college grad making $60,000 a year. So that brings his gross monthly income pre-tax to $5,000 a month. Devin has just bought a property. His mortgage is $1,500. Utilities is $300. So that brings his total to $1,800 for this example. Just walking through debt income ratio is simply going to take the ratio of 1,800 to 5,000, just 36%. Straightforward. So for a single property, it's straightforward. It illustrates it. But now this gets tricky as you begin to consider adding on more property. So let's say in a simple case, if Devin wanted to buy another like-minded property, right? So that would brings his mortgage to $3,000. That brings his utilities to $600, for instance, right? So obviously that's $3,600 total. Obviously, income ratio is 70%. I keep in mind, going back to conventional loans, it varies based on whether there's a USDA, conventional loans, FHA. So conventional loans, the ideal max for front end, I believe, is like around 28%. And back end, where you factor in everything, is 36%, but I think they've pushed it now all the way to 45%. But still, the point is like this would fly, right? So from a scaling perspective, it's like, oh shoot, like obviously this is not possible. Devin is probably not going to get approved for or not, a second loan, right? Again, with the same income, unless he can successfully double his income. So the only scenario where this might work is if Devin can similarly double his income. But what are the chances Devin goes from making so if he wants, so let's say after his first year, he bought his first house, and let's say he wants to buy another property second year, or maybe even 2 years after, what are the chances of Devin going from making $60,000 a year, $120,000 a year, 1 year timeline or 2 year timeline? Slim, not impossible, but slim, right? So in that case, so there has to be a more strategic and smart way to scale to keep the debt to income ratio within a reasonable amounts. And that's something, and I'm going to walk you through the second scenario here, which shows you exactly what underwriters are looking for if you want to get a pre-approved for a second loan. Obviously, typically, of course, while scaling your active income or your 9 to 5 or whatever, more difficult. That's why a lot of real estate investors tend to go with the option of converting properties to cash flowing assets. So in scenario 2, we have Devin. Obviously, he wants a second property, but then in this scenario, he converts his first property to a cash flowing asset or an investment property. So now, typically, again, this is fairly straightforward for long-term rentals. So typically, what you have to do typically in this case is, okay, you have your first property, you have plans to sell it or whatever, or not even sell it, rent it out and buy another one because you want to hold the property or keep the property. So in a case like this, banks would probably give you like a conditional offer. So what banks would basically say is, okay, fine, we will pre-approve you for a second mortgage or second loan rather to buy another property provided you can lock down like a lease, like you find a tenant who's willing to pay you rent to cover the expenses from the first property. That's called a conditional approval, and that happens a lot. So what you see is like if someone buys a house and they're looking to buy another house, what they'll see is like they'll get conditionally pre-approved for another loan, and while they're still home shopping, they'll find another person who's willing to lock in a lease agreement, and the person signs a lease agreement for typically at least a year. And the person basically says, hey, I'll pay you, in this case, $2,300 a month. And then you take that lease agreement, signed, documented, sealed, everything to the underwriters for which work for the mortgage company. You're trying to get the pre-approval for the second loan. They see that, and then what that looks like is simple. So just a bit different from the first scenario. What they're going to do is, okay, they'll say now they'll treat your first property not like how they did in this scenario, but rather they'll treat it like as an asset or an income source. So what they'll do is they'll look at your mortgage and utilities similarly, like we did before, $1,800. Now they're going to factor in, based on your lease, the amount of rent you'll be receiving, right? So what they're going to do, actually, I included utilities, but you don't need to, because long-term rental, you're not covering utilities. Actually, the tenants cover that. But just for the sake of argument, let's even leave that in here, right? So $2,300. And then what they'll do is basically say, okay, look at your income or cash flow from the property or loss. Look at your income or loss from the property. But basically what they'll do is they'll look at your income in this case. So they'll look at $2,300 minus $1,800, which is $500. And then what they'll do is now trying to get you pre-approved or get you approved for the second property. Similarly, then they'll just basically treat it like they did in the first scenario, your first property, where they add up your total housing expenses. But now your total income won't just be the $5,000 from Devin's salary of $60,000 a year. They're going to add in the $500, which we'd be receiving, or Devin will be receiving from his first property, which is converted investment property. So now that makes his total income $5,500. Makes now his total, even though his debt is higher, right? Because now his mortgage is $1,600 and his utilities is $350, which is being $1,500 and $200 year $1,800. So total year is $1,950. Still, his debt income ratio is even lower. Even though his new property has a higher housing expense, his debt income ratio is actually lower marginally, still lower. So Devin here looks way more attractive to a lender than Devin here, despite having the same active income, but now he obviously is converted one property to a cash flow. So obviously, what does converting a property to an investment property look like? It's fairly straightforward and not as complex as people think. All this really means is Devin calls the mortgage provider for his first property and say, hey, I have gotten conditionally approved for a loan to buy another property. I just want to give you a heads up that I have someone who signed a lease for so time. They'll be moving in 2-3 months. And then in 2-3 months, this property becomes an investment property. Okay, thank you, sealed. That's it. So it's as simple as a phone call. It's not a very complicated or difficult process. So that's walking you through debt income ratio, why it's important. And also this is also good to like walk through and do as well when you're thinking about, okay, what should I target for rent when I'm like trying to find a tenant to sort of like keep my debt income ratio in a reasonable amount or reasonable range, also to keep me attractive to lenders. So this is debt income ratio. This is just diving into it. I just want to set the groundwork for this so you guys understand it, also understand how it works when it comes to scaling. So as you can imagine, if you wanted to do another property, just doing another scenario, let's just do it real quick here on the fly, right? If we wanted to do another scenario, so I'm moving this down. So let's call this property 3. So let's say this is a year even later, right? And so typically also when you're converting a primary residence to an investment property, typically lenders only want you to be in that primary residence for a year. So just FYI. FYI, it doesn't have to be like a full like 5 years or nothing. You just have to stay there for a year. So this is a new primary residence. So in case, let's just say, actually, you know what? So let's say here now, same thing. So income or loss from property. So let's say in this case, I'm actually just gonna say, oh, I didn't put the tab, but let's just say they're collecting a rent of $2,300 again to keep things simple. And there are, yes, sorry. And they are, so basically the income from this property now is 350. So similarly, as you can imagine, just like we did previously, you're gonna add your total income now will be this plus this, plus of course, this bad boy right here, which is income from the second / new investment property. And then obviously your total debt will be the same. So let's say even this one now, let's say the mortgage for this one now is, let's even say 1750, right? And I said mortgage for this one 1750. Yeah, so that brings the total debt to let's say this total debt now is $2,100. So even with $2,100, and just keeping that in mind, so with almost $310 more, $310, yeah, with almost $300 more debt. However, because of a growth in the income, and the income growth is coming from 2 cash flowing properties, right? Obviously his debt income ratio stays even lower in scenario 1 still, and even looks even more attractive. And that's the crazy thing about this thing, right? So people always make this mistake. People are always like, oh no, you're taking more mortgages, you're gonna look unattractive to lenders. No. So as far as the amount of mortgages you have and debt you're taking, of course, we talked about previously a way to do it and scale sustainably. So I'm going to link that as well. Remember, we talked about previously how to scale sustainably to make sure that you're keeping in mind your debt. So you want to look at your income to debt ratio or cash flow to debt ratio. For sure, you want to always keep that in mind. You want to make sure that you're leveraging your debt that you're taking in the most effective way to maximize your cash flow. But that said, no, this is what is important. Most underwriters typically want to see one. Okay, sure, you're taking on debt. Are your properties positively cash flowing? So again, with long-term rental, this becomes easy, right? So just stop sharing my screen here. This becomes easy with long-term rental. However, it gets a bit more complicated with short-term rentals. And that's what I'm going to talk about today, about being smart with your tax write-offs. So long-term rentals, it gets easy. However, I would also say this, though. Actually, let me say this. Caution or warning, even for long-term rental real estate investors. Now, more and more underwriters are not just, so before, historically, whereas a lease was okay, I'm hearing more and more now about underwriters demanding more than just a lease. So if you've owned a property, if it's a new property that you've never cash flowed, they understand that it doesn't have a tax return where you filed or reported income on that rental property, so that the lease will suffice. But let's say, for instance, in that scenario 2, where he's now talking about getting a third property, right? So sure, even though property 2 may not have a tax season where you filed or reported rental income on it because it was your primary residence. However, now I'm hearing more and more now that mortgage lenders will say, okay, sure, property 2 doesn't have you haven't reported income yet on any tax filing for property 2, but I'm guessing you have on property 1 because you've owned that for 2+ or 3+ years now. So what they're still demanding is they would want to see your tax returns and the income you reported. And so they want to see specifically the net income or loss you reported, net rental income or loss reported on that property. And now this is where tax write-offs comes in. And this is the second part of our weekly tip, and why it's important to keep in mind tax write-offs, and why it's important to be smart with your tax write-offs as you're thinking about scaling your property long-term. So when it comes to tax write-offs, okay, this is something I really want you guys to pay attention to. Real estate is a great tool, especially owning a cash flowing property or an investment property is a great tool for tax purposes. We've talked about that, depreciation, and obviously there's a lot of things you can write off. So for instance, if I own a rental property and I decided to do renovations on that rental property, that even though that renovation is value adding, let's say if I put a fence, that increases the value of the property, for instance, I can write that off as a business expense, on tax write-off. And so I'm giving examples of, like, in general, why owning a business period in a place like United States has very, very positive tax benefits. However, people can get very reckless with the tax write-offs, and here's what I mean. So now, in the case of what I just mentioned with underwriters, so obviously in the example or scenario we showed, they're using your lease And then based on your lease, they're doing the front end debt income ratio. So they're using the lease basically to essentially ascertain what the income or loss is from each property. However, when it comes to tax, so if you've owned a property for more than a year and you've probably filed or reported income on that property, the chances of the underwriters asking for rather than simply just a lease agreement, but also a tax return is very high. And they're looking, that's for a tax return, not just for the income from your job or your W-2, but also for a tax return because they want to see what did you report on the Schedule C, Schedule E, or if you done an LLC on your business tax filing, what did you report as the income on this property? And that is very important. Now, factoring in depreciation, and I want to keep this in mind. This is why it's very important. Depreciation, we've talked about that before. Again, I'll link the post on that. But basically, with real estate, you can claim depreciation on a property amortized over a 27.5-year period. So basically, if you have like a $250,000 property, you technically could be able to claim depreciation as much as up to, just taking a ball estimate year, like $10,000 a year, right? On average, you can claim that as depreciation on property. Now, here's why tax write-off is key, and here's why it's important. When you're reporting your income for taxes for real estate, you will report your gross income that you made off the property. So that would be simply just, if you're doing short-term rentals, you obviously, or long-term rentals, obviously you just report what is the money you made monthly or throughout the entire year on that property. And also you report your total expenses. And this is where you report your expenses, which are obviously like the mortgage and utilities. Those are simple, straightforward. And then obviously you then start factoring tax write-offs. And here's the punchline basically to everything I'm saying. The smart way to leverage tax write-offs is to ensure that when you add back in your depreciation to your tax returns or your net income that you reported, you want to make sure that when your depreciation is added back in to your tax reporting, that is at least positive. Now, definitely always like report fairly. One thing I would definitely not recommend you do is play with Uncle Sam. So don't play Uncle Sam. So obviously, if even before depreciation, if like your net income is positive, report fairly. I'm not saying like make it negative, but sometimes you see like, okay, so perfect example. If I had a property, right, that was cash flowing me $100 a month, right? So that means when I look at just the money I'm making from rents and look at the total expenses like mortgage and utilities, I'm making $100 cash flow, $100 profit. So that's $1,200 a year, right? $200 cash flow. So what I'm saying basically is now you can have a tax write-off. So basically, if you have a tax write-off, like you bought you put a fence for $2,000, and then so obviously you write that off on your taxes as another business expense. So obviously that will put your net income to $800 loss, because obviously it was $200 profit for the year. Then you add in the tax write-off, and so that's $800 loss. And then when you factor in on top of that depreciation, so if your depreciation is $10,000, that's negative $10,800, right? So because depreciation is also another tax write-off, and depreciation is cool because depreciation is not an actual cost. So depreciation is it's something, again, it's depreciation on the material and the building, right? So it's not an actual cost because I didn't actually incur a $10,000 loss, but it's something that by virtue of owning this property, I'm able to take advantage of. And so it's not an actual cost. So keeping that in mind, but still my total loss for the year could be $10,800, but keeping that in mind, and so knowing that underwriters, when they look at your tax returns and they see that negative $10,800, always remember this: underwriters will always add back in your depreciation because they understand that it was not an actual cost, right? So if they see your Schedule C, your Schedule E, whatever, your tax returns, and they see, okay, for this property, you reported negative $10,800 as your loss, right? But they see that, okay, $10,000 of that is depreciation, they'll add that back in. So really for the underwriters, they'll see, okay, for the year, you made a loss of $800. Now, here's why that is important. For tax purposes, okay, imagine a case like that where I do report that $2,000. Oh, I'm trying to get Uncle Sam. I want that $2,000 off on my taxes, right? I want that $2,000 as a tax write-off. Here's why it gets tricky, okay? So just let me go back to the scenario where we had just two properties, because I feel like that makes things easy. Yes, so we're back to scenario where we had just two properties. So again, just as a recap, Ignoring all of this, right? Ignoring all of this, right? In fact, I'm just gonna delete all of this. In the case where we are using, in the case where we are using our tax returns, right? So our yearly net loss, right, from our tax returns. Remember, keep that in mind, right? This is very important. Remember, we had negative $10,800 reported, but like I said, they will always add back in depreciation. So keep that in mind. So you basically what that looks like is you pull your tax returns, right? See negative $10,800, and they see, oh, of that $10,000 is your depreciation. So they just simply add that back in. And so what you see now is a yearly net loss of $800, right? So you divide this by 12. Just showing you guys all the numbers. So that means that's basically a monthly loss of about $67. Again, I'm just doing this on a small scale. So the thing about tax write-offs is this is where it's important. Using that same scenario, so in the past, we saw how like basically if they use your lease, they take the difference between the rent you're receiving and basically the mortgage you're paying on the property, and they have that your net or your income rather from that property, and they add that back into gross monthly income. Similarly, if your yearly income from your property is a negative, so basically not even an income, if it is a loss, even after adding back in the depreciation, right? What happens is they take that loss yearly, divided by 12, get your monthly loss, and they just subtract that from your monthly income. So basically, we'll just add that back in right here. What you see, friends, is obviously you get the idea. So basically, actually, by virtue of wanting to claim that money, right? Once to claim that $2,000 as a tax write-off for defense, now the total income that they're using to determine his DTI is 4933. Now on the flip side, right? If it chose not to claim that, $2,000, so basically that means adding back $2,000 to the pot, and that means he didn't report as a tax write-off the investment on the fence, adding back the $2,000 in the pot. So you guys get what I'm saying. So that means he had obviously going back to example, $1,200 a year profit, so monthly profit of $100. Rather, right, his total income will be $5,100, right? And his this should not be yearly. This should be monthly because we're dividing by 12. My apologies. So this should be monthly. Okay, so now, again, just flipping back and forth, right? Scenario one, right? He had the monthly loss. Again, just ignore this. This should be monthly. But he had the monthly loss of about $67, and that made his DTI 39.5%. And going back to the fourth scenario, he had a monthly profit, so because this will be profit now, because obviously he's making positive $100, and that made his DTI 38%. Now, obviously, in this case, where it's anywhere from 38 to 39%, of giving my example, it's probably inconsequential. So in a case like that, I'll probably say it doesn't really matter. You'll probably be fine reporting that anyways. But again, you can imagine a case where maybe, let's say even the tax write-off was even crazier. So like the point I'm trying to make is like, these are things or situations you should always keep in mind with your tax filings when you're thinking about like long-term growing your portfolio, because excessive tax write-offs, especially tax write-offs that puts your yearly income at a negative, even after adding back in depreciation, can hamper your viability or your attractiveness as a potential borrower, right, to potential lenders. So always keep, that's the punchline. I know I essentially did all this in a long-winded way. That was intentional. I want to make sure you guys really understand what is going on here. But the summary of what I'm trying to say is like this, your tax write-offs have consequences. Always remember that. They always have consequences. I'm not saying you shouldn't write the tax write-offs up. You should absolutely should. And also that's another cool thing too about real estate. You can also report a loss on your business, right? But what's important is, for me at least, is when I'm looking at my tax write-offs, and there are times where I've chosen not to report a tax write-off because I know that would put based on what I'm doing or filing my taxes, that will put my income from the property, even after adding back any depreciation, at the negative. So for instance, let's look at a good example. Let's say I have a property that makes me $20,000 a year, right? Let's say I have a property that makes $20,000 a year, right? Let's say I can claim, let's say I claim up to $15,000 a year, right? Tax write-offs, so right, that puts me at 5,000, right? Let's say I then subtract another 10,000, right, which is the depreciation. That'll put me at negative 5,000. So in a case like this, I am totally fine with this because, again, going back to our example, right? The underwriters see negative 5,000. I reported a loss on my business. However, when they add back in the depreciation, right? Provided they see, oh, okay, well, adding back in the depreciation, which is, again, not an actual cost, he's making profit from the property every month. So that is fine. That's perfect, because that's all they need to see. So that, always keep that in mind. That's all they need to see, because what's key is that when the depreciation is added back in, again, if there's nothing else you take from this, just always remember this. When dealing with tax write-offs, what is key is that when the depreciation is added back in, lenders want to see you're still making a monthly profit of the property, right? So what is key here is like making sure when depreciation is added back in, making sure this is still positive, that is added rather than subtracted from your gross monthly income if you have a job or whatsoever. So obviously, if you can imagine, if you have your income is higher, it would help your debt to income ratio specifically, making it lower. And okay, so with that said, yeah, that's pretty much it. That covers most of what I wanted to talk about today. Again, we covered debt to income ratio more in depth, and we're going to be focused on front end. We talked about how it works with leases and long-term rentals. We also talked about, okay, switching over to when it comes to tax returns and tax filings, which is something that more and more lenders are requiring and doing if available these days. It's very key that when they pull your tax returns and they pull your income on your rental property, that income, right, when they add back in, so if the income is already positive, even with after claiming depreciation, great. Then that means when they add back in depreciation, it's even going to be even higher. But if your income is negative, right? So I'm speaking more because obviously this tends to be, people want to one up Uncle Sam. So people tend to report losses on their rental property because you can. I mean, and that's one of the cool things about real estate. You can report losses on your rental property for tax purposes or tax gains, and basically you're still getting approved for loans because, again, what is key here is if you're reporting losses, when you add back in depreciation, right? So because depreciation is not an actual cost, I'm going to wrap up with this. You want to make sure that after the depreciation is added back in, ideally you're still positive, or you are positive, so that positive number obviously divided by 12 and get your monthly income with depreciation added back in. And they want to make sure that's positive because ultimately, by being positive, they can add that into your total income, and by adding to your total income, that can obviously help your debt to income ratio. And with that, we're signing out. That was today's weekly tip. That was a bit longer, necessary, because I think this is a very important topic, and it's one thing I definitely didn't want to gloss over as more and more patrons are acquiring properties. And I'm very proud of you guys. I'm seeing a lot of you guys more and more acquiring properties. This is definitely something I did not know in 2018, and I wish I did. Thankfully, it wasn't really a big deal because I was able to grow my income, and then obviously knowing that I was able to get hip and know the game. But it's definitely something that if you are buying the properties now and you're thinking about scaling for the future, keep this in mind. That's signing out. Y'all take care. Stay blessed.